Another weekly market commentary from StashAway. With us again, our Chief Investment Officer, Freddy Lim. Hey, Freddy.
Hello, and this time from StashAway's videography room.
Wow. Times are improving, it seems. I'm still at home, but I hope we can do a combined video again in the future soon at the office. With that being said, we have a couple of things to discuss. We got a good question as well from last week's video, Freddy. So let's go straight to those. In terms of markets, right? Obviously, it's been dominated by the Democratic nomination convention. Now we're having the Republican convention the next couple of days, right? So it's a lot of obviously posturing. However, some little good news came at the earlier part of the week, right? And the phase one trade deal is actually making some progress. Maybe you can tell the listeners a little bit more about what's happening there?
Yes, remember, we have a phase one trade deal between China and the Trump administration that was negotiated early in the year. And it requires China to show sufficient amount of reforms when it comes to fair dealing and fair treatment of foreign companies and trade practices, intellectual property rights. So the progress there has been officially endorsed by US as making good progress. Now, what's falling short in this phase one trade deal is China's inability to buy this sufficient amount of agricultural products from the US as agreed in the agreement. And in a way, this is sort of a function of a result of the COVID-19 situation. So it remains unclear how they would take this forward on this part. But things are not looking as bad as we feared.
Yeah, exactly. I think especially on the purchasing part, difficult during COVID, right? Especially the last 3-4 months with supply chains being broken. On the other hand, also good news, right? The stock markets are making new all-time highs over the last week. Especially from fueled by the tech advancements in the tech stocks, right? But when looking at the S&P right now, right, it's all-time highs. Do you still think it's cheap, or is it very expensive at this point in time, right? Like, it does make up a lot of percentage. It's made up by technology, right? But a lot of it is not, right? So how do you see that?
Well, what's going on is that there's been a lot of names dropping out of a lot of indices, not just the S&P. Like, for example, the Dow. I think ExxonMobil is dropped out now. Energies don't do well. And there's a lot of new names in town. So the market value approach to weighting an index, that's what happens. It creates a winner bias, right? So where the winners gets bigger and it gets more weights in index. So the S&P 500 is similar, is reflecting more performance now with more weightage by Apple and all the other tech companies. And what's the losers will have a shrinking say in index. So that's exactly what happens there. Now, as to whether the S&P 500 is cheap or rich, one can never tell from just by looking at the charts, right? I mean, we've seen a lot of people do that. You can never do that because there's a natural rate of growth and earnings over time when it comes to the real economy. And hence the S&P 500 is like you invest $1 and 100 years later, it's always going to grow. So looking at the index level is never really a productive effort to see whether it's rich or cheap. What people has been doing is to look at fundamentals. And there's some interesting research out there, a camp where they think the S&P 500 is actually cheap versus fundamentals. And the argument being that look at the output gap, right? Output gap is the economy's actual output level now versus its potential. It's so low versus its potential, and yet the S&P 500 is here today. What if things becomes better, the vaccination came, and the traffic came back, the volume comes back, then wow, what would the S&P would have done going forward? So that's that forward-looking approach that says, based on the output gap, the S&P 500 valuation is not rich, but there's also another camp that thinks it's rich. So you can say what you want. A lot of people have a gazillion opinions on this. And I think ultimately we need to remember, regardless of what the market is doing in the short term, we need to focus on diversifying portfolios.
Yeah. And also, like you were just saying this, right? Goals, right? How far away is your goal, right? And so if you're looking at, yes, could there be a second wave hitting or like a third wave hitting before vaccine is out? It might go down a little bit, right? But ultimately, where do you see yourself in 10 years' time? And I think you made a good point there on, companies tend to grow over time. Otherwise, they get replaced by other companies, right? So especially on the index levels, right?
Exactly.
A great explanation there, Freddy. Thank you. Last on the news front, Singapore industrial production numbers came out, right, this week. Worse than expected. So, what's being expected, no one knows these days, but it was worse than what the analysts expected. How would you put that into context for listeners?
Well, the median survey of all economists says that the survey expected around 3.7 percentage point of monthly improvement this time. And also earlier in the month, we got data on the Manufacturing Purchasing Managers Index, which is more of a forward-looking component. However, the number came in disappointing at 1.6% month-to-month. And I figure the real reason is that the purchasing managers and all the surveys, they're looking ahead even further than this month's data. So what the survey has done may not be wrong in the sense that maybe it's just not being reflected yet. So there is a positive lining here, which is managers as buying parts, investing for companies in CapEx and making hiring decisions, business plans. They do think that things are improving more than what is currently shown. And we're not seeing it now. We're still technically in a recession for Singapore in terms of the numbers, but the forward indicators shows some sort of improvement.
Yeah, and let's go then over to the questions from our listeners, right? So for anyone who's new to listening to these videos or long-term listener, as always, please feel free to put any questions down below the video so that we can pick those up on a weekly basis and address them directly for you on the videos. Today we have a question from Sebastian. He's saying, hi both, thanks for keeping us informed in these uncertain times. I have a question regarding your allocation choices. Is it purely data driven by your model, or do you also have to make a choice based on your experience? Also, do you have discussions with other fund managers to assess market sentiment, right? So 2 questions there.
Right, on the first part, I would say that we are a data-driven firm, and our models are data-driven, and they have a lot of rules baked into it. It's like a forest of decision logics, if-then statements. If A happens, go here, and then if B, and subsequently B happens, go somewhere else. Right? There's a forest of decision logic when it comes to machines, and and then separately we have an investment committee that provide the independent oversight, looking at risk and looking at the input data, how good they are. Is there any garbage in, garbage out problem, right? So in a way, we have a combination of gatekeeping oversights from the committees, but the primary decision logic for allocation is still driven by ERAA, which stands for Economic Regime-Based Asset Allocation. It's a StashAway investment framework.
Perfect.
On question two, sorry, can you remind me the question 2 again?
Well, you have discussions with other fund managers to assess market sentiment.
Well, we very much rather like to collect the big data analytics than to talk to people, because our sample could be small. There's the millions of participants in the markets every day. Speaking to 30, 40 people is inefficient and is not representative of a sentiment. So we do look at other data points, looking at leading indices, looking at survey data, and constantly looking out for even more choices for that. However, we would rather feed these data points into our machine for it to digest and hence be able to provide guidance, right? So that remains our approach rather than a manual approach.
Yeah, thank you, Sebastian, for asking those questions. Really appreciate it. We also have a couple upcoming webinars over the next week. For Singapore, we actually have an Ask Me Anything live on our StashAway Simple product. That's on Monday, the 31st of August from 7 to 8:30. So if you want to sign up for this, again, links are in the show notes below, as well as on our website. And in Malaysia, on Wednesday next week, September 2nd, from 6 to 7 p.m., we have a webinar called How to Plan for Your Retirement, where you can learn a lot of different strategies on improving your retirement and setting yourself up for success on that. With that being said, I hope you enjoyed today's show again. Me and Freddy will be again with you next week, and looking forward to that. Have a great rest of your week. Bye-bye.
Ciao.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.